Good morning, everyone. Welcome to Yorkville Capital Management's quarterly MLP update and fundamental review. My name is Will Hershey, and joining me on today's call will be Yorkville portfolio managers James Hugg, Leonard Edelstein, and Darren Sharinga. The presentation will be followed by a Q&A session. Questions can be asked by typing into the submission box in the top left corner of your screen. And with that, I will turn Darren over to begin the presentation.
Thank you, Will. Good morning, everyone, and thank you for joining us for our quarterly conference call. And it's been a pretty hairy ride in MLPs over the last couple of months, so we'll also touch on that. The first slide, for those of you who are not familiar with Yorkville Capital and our expertise, we're a firm that is solely focused on investing in U.S. energy infrastructure through master limited partnerships. And we are pioneers. We've been successfully investing and researching in MLPs since the early 1990s, and that is relevant because the asset class in its modern day inception was created by the Tax Reform Act of 1986. As a firm, we have one of the longest audited track records, and I know a lot of people have been doing things for a long period of time and are still not very good at it. Fortunately, we are very good at investing in MLPs, and currently we are the top-rated manager, is ranked by Pensions and Investment magazine. So the topic for today's slide, before we get into the performance of Yorkville's MLP core income strategy, which is our flagship strategy and is our actively managed product offering, we want to talk a little bit on what's going on in the market. So what we've been hearing from investors in incoming calls: what do lower energy prices mean for the outlook for master limited partnerships? Number two, and what should investors expect from MLP distributions given lowered oil prices? So MLP's recent pullback, let's put that into perspective. Today we looked at the pullbacks in MLPs, the top 10 pullbacks since the Great Recession of 2008. And just to simplify it, if you look at the bottom line of the slide, the average pullback since 2008 has been 11%. The time to recover, so again, if investors had terrible timing, they bought at the top of the market and suffered the entire drawdown or pullback of 11%, they would have been back to where they purchased the investment within 25 days. So within 1 month, investors would have been made whole again. Now, even better, so that's the worst case scenario. The better case scenario, now we can never time the bottom, but if they purchased at the bottom, the investor's return would have been significantly better over that time frame. MLPs are still down from their highs. We view this as a good entry point to either increase exposure to the asset class or to establish a position if you are sitting on the sidelines right now as an investor. So our conclusion from this slide: average pullback 11%, which is not insignificant. Recovery time, if you bought at the worst possible time, the peak of the market to the trough would have been 1 month. So pullbacks have been buying opportunities in MLP for MLP investors. Now why is that? So let's look at the most extreme example, and I referred to it earlier: the Great Recession, the financial crisis of 2008. MLPs pull back in line with the markets. MLPs dropped, as you can see here, almost 40%, which was in line with the S&P 500. Now, what didn't happen, and this is the title of the slide, strong fundamental support price, is distributions were not cut. So to put that in perspective, you look at Yorkville's core income strategy, our MLP core income strategy, which we're talking about today on this call, 100% of the names in our portfolio through the worst financial crisis of all of our investment careers, as stated by Warren Buffett, 100% of the names in our portfolio maintained or increased their distributions through the worst financial crisis. So what we like to say there, when we look at that stability of distributions, those are the characteristics of fixed income that MLPs offer, stability of distributions. So like a bond, investors really are concerned about two things. One, that the company will make its interest payments on a quarterly basis. And number two, that when the bond matures, the investor will get paid back at 100 cents on the dollar, so at par for the bond. So MLPs, the stability of distributions throughout bad markets, when, again, putting in perspective, oil dropped from $140 a barrel to $40 a barrel over this time frame, 100% of the names in our MLP core income strategy maintained or increased distributions. And so all of a sudden you had a yield rally, and across the broader asset class, 75% of all MLPs maintained or increased their distributions. And the decline in income across the entire asset class was only 9%. So Yorkville added alpha. Number one, there's room for active management. 100% of the names in our portfolio maintained or increased distributions. But as an asset class overall, it's still high quality. 75% maintained or increased distributions, and the decline was only 9%. Again, stability of income, you had a yield rally. Since income remained stable, all of a sudden what happened is MLPs started to yield in the mid-teen levels. Investors realized that, and the next bar here in 2009, you had a rally of 80% in the following year. So again, putting in perspective, worst financial crisis, 100% of the names in our portfolio maintained, great stress test for our portfolio in real life, maintained or increased distributions. There was a yield rally. And what investors experienced who bought it at the worst possible time, again, just before the meltdown of '08, would have been made whole from the trough within 1 year. Okay, it took 5 years from the low of the S&P 500 before investors made their money back. Because MLP distributions remained stable, the returns were much more rapid. So strong fundamentals support price, and that's been our argument, and that's the lesson that we've learned since 2008 going forward. And we'll talk on a couple of scores in a moment that we created to help investors track the asset class overall stability and growth, so the health of the asset class. The next slide looks at the correlation. So I think '08 is the best example, 140 to 40, and we saw price declines, but we didn't see fundamental declines in cash flows. Here we look at the correlation of MLPs, and that's the far right column, relative to oil prices. In this case, we looked at the declines in oil prices since 2000. And these are the top 10 declines. So you can see on average, again, the bottom row of this table, on average we saw declines in oil of 26%. And MLPs over this time frame basically were flat, down 3%. So just looking at the correlation in price, so what would you expect from price movements in MLPs relative to oil? There's a slight correlation. If the correlation was 1-to-1, oil drops 26%, you'd expect MLPs to drop 26%. Over this time frame, the price of oil declined 26%, MLPs were down 3%. So the price performance of MLPs, given the fundamentals, do not track the decline in oil. MLP fundamentals, cash flows are not tied to commodity prices, which is one of the reasons we state often here at Yorkville that MLPs are a great way to play the U.S. unconventional shale revolution or energy revolution without having to be right on the directional movement of commodity prices. That is, commodity prices need to be going up. The next slide here, we take a look at the price of oil and natural gas relative to the absolute distribution. So there's a lot going on in this chart, but let me simplify it. The bars that you're looking at are the distributions paid by MLPs from 2003 to 2013. And you can see that every year except for '09, there's been there's an upward trend overall. In '09, there was a slight downtick. In the Great Recession, that was 9% reduction in income overall in the asset class. But every other year, you've seen income move up or distributions from MLPs increase. And 2010 was a new record year, 2011 was a new record year, 2012, and now 2013 was a new record year, and 2014 promises to be yet another new record year for distributions. So MLPs, the growth of distributions, I already mentioned the stability is the fixed income characteristics. The growth of distributions, once we have stability, growth of distributions is the equity characteristics of MLPs. So you can see consistent growth of distributions across time and across market cycles. We overlaid on this growth of distributions here the price of, on the left side, that's the price of oil from $30 to $110. And you can see the line where oil in 2007, these are year-end prices we use, is up around $100. In 08, it drops down to $40. And you can still see that over that time frame when oil dropped that significant amount, distributions continue to increase. And then in 09, you had this slight 9% decline. Nothing that we're experiencing in the market today is anything along this magnitude. We didn't reach the same highs, and we didn't reach the same lows of $40 a barrel. The same thing holds true, and it's even more striking an example, in my opinion, in our opinion as a firm. The dotted line is the price of natural gas, and it's on the right axis here, the price of natural gas over time from $2.50 to $27.50. And what you're seeing back here in 2005, natural gas prices peaked, and in 2011 they troughed. They actually got under $2, but here year-end pricing was a little above $2.50. So roughly they went from 15 to 250, and from peak to trough. So a steady decline over a 6-year period here from 05 through 2011. MLP distributions still were increasing over that entire period of time. And from 15 or to 250, you had pricing cut down by over a fifth of what it was before, and distributions still increased in MLPs. The reason for that, again, MLP, the business model, long-term contracts, primarily in the infrastructure side of master limited partnerships that are more like real estate. You're leasing space out, and and companies are buying capacity on your pipelines, and they're paying for that whether they're using it or not. So that's why you're showing the stability of pricing across commodity cycles, and that's one of the benefits I mentioned earlier of stability of distributions. So master limited partnership fundamentals are not tied to energy prices. So long term, whether over the short term we see a correlation like we have, oil's come down, MLPs have come down. As long as the fundamentals remain strong in the asset class, it's a great buying opportunity. The two scores that we created, and these are proprietary to Yorkville, to help investors gauge the overall health, is a great way of looking at it, of the asset class, is our stability score and our growth score. The stability score goes from 1 to 10, and a score of 10 means 100% of all publicly traded partnerships, of all master limited partnerships, maintained or increased their distribution. So the way we like to look at this is the fixed income characteristics. Do we have broad-based stability across the asset class? Are a lot of partnerships cutting their distributions, or are most of them maintaining or increasing? We want to see scores around 10. I mean 9.8 is wonderful. We want to see most partnerships maintaining or increasing their distributions. The second part of the equation, which is the equity-like characteristics of MLPs, is growth. And so what we see across the entire asset class, and we'll compare this to Yorkville's MLP core income portfolio in a moment, is MLPs grew their distributions. And when I say grew their distributions, that means cash investors received on a year-over-year basis grew by 7.1%. Broad-based stability, 98% of all MLPs maintained or increased their distributions, and they grew their distributions by 7.1% on average in the most recent quarter on a year-over-year basis. So what does 7.1% growth mean? Well, if you annualize, if you look at that using the rule of 72, which is 72 divided by whatever return is you take 72 divided by a return is how long it will take in measured by years to double your investment, it would equal 10. 72 divided by 7.1 is 10. Every 10 years, if growth continues to materialize across the asset class at 7.1%, investors will double their money every 10 years. Now, I know most of you wish you doubled your salaries every 10 years. I know I do. MLP asset class promises that type of growth in cash flow to investors on an annual basis. And growth is really the investment thesis that underpins MLPs. So, because growth, if we move off of the fear of commodity prices, this growth is what provides investors, this growth of income, with a hedge against inflation long term and protection against rising interest rates. Because as income continues to increase, the yield on the asset class also continues to increase. A quick update on the asset class, just looking at performance for the third quarter of 2014. We compare MLPs to equities in the U.S. using the S&P 500, to REITs, to utilities, and then we look at MLPs. And we use REITs and utilities because they are good comparables. They're alternative sources of income that investors look to, and we like to compare what investors are getting when they buy REITs or utilities relative to MLPs. So for the quarter, you can see that both REITs and utilities were slightly down in the third quarter of 2014 relative to MLPs, which produces positive returns. They were slightly up 1.7%. On the year, which is the bar on the right, the S&P equities overall for investors in U.S. equities, they're up 8.3% on the year. Investors in REITs or utilities up 13%, and investors in MLPs on average were up 20% for 2014 through the third quarter. This is one of Len's favorite slides because what it talks on is the power of compounding of returns over time. And the doubling of income is the way income compounds over time. Every 10 years your income will double as long as MLPs continue to produce 7% returns across the asset class. When you look at the returns of the asset class compounding over time, we go back to 2000 through the third quarter of 2014. $1,000 invested in MLPs, it could be $1 million invested in MLPs, would have grown to 11 times that amount. The next most comparable investment would have been an investment in REITs, which would have grown to 5 times the amount. So MLPs, relative to the next best investment, is 2 times. You look at it, the same $1,000 invested in the S&P 500 over the past 14 years, an investor would have returned 80% on that money. While relative to MLPs, you're looking at more than 8 times the amount of return from MLPs relative to S&P 500. And it's a conversation that I had yesterday with an analyst looking at just broad-based equity exposure, and the analyst asked me, well, why wouldn't investors replace equity exposure, S&P exposure with MLPs? They're getting more income, better performance, similar risk profile to equities, and low correlation to other asset classes. And I said, it's a good question. And this chart just shows what MLPs mean in a portfolio relative to the other asset classes in terms of total return potential over time. Again, driven not by a bubble, but by fundamentally increasing distributions over time. And the value of MLPs can always be seen because it's cash flow investing on the next slide. MLPs as an asset class are yielding 5% currently. And they've delivered the outperformance that we just showed on the previous slide of 2 times that of REITs and over 8 times that of utilities and S&P 500. They're still yielding more. If they were a bubble, you'd argue they'd be yielding less. They're yielding 1% more than an investor would get from a similar investment in REITs. They're yielding 1.3% greater than an investor would get in utilities. So alternative income sources from equity or infrastructure investments or hard asset investments, you're still finding more income from the MLP asset class than anywhere else in spite of the run that they've had. That's because MLPs are growing faster than utilities or REITs and offer more stable income. And I know if you've listened to a few of these calls, you've heard me say it before, REITs during the downturn of 2008, they cut their distributions by 50%. So any of your investors, or if you are an investor, it's really hard to overcome a 50% reduction in income, and versus a 9% reduction in income that you would have experienced in MLPs overall, or with Yorkville, there would have been no reduction in income. So as 100% of the names in our portfolio maintained or increased distribution. So MLPs still on a valuation level yielding 5% are the highest yielding alternative income investment available within North America right now, and specifically in the United States. I'm going to move forward to the final part before I open it up for Q&A here, is talk about our core income strategy. This is Yorkville's actively managed portfolio. It has the longest audited track record, MLP track record. It's moving to the close this December of its 13th year, and in 2015 we'll be moving into its 14th year of audited results. And let's see how it compares relative to, let me step back. Really what we want to look at here is can Yorkville add value to beta exposure or just broad-based MLP exposure? So what do we bring to the table? And these next slides are really the report card to judge on how we are doing, how we are delivering, and where we as a team, as an investment team, believe we can add the most value is through improved fundamentals across the portfolio. And so let me talk about that over these next few slides. So our core income strategy, the current yield on the portfolio right now is 4.5% relative to the MLP Universe Index, which is 5%. All these numbers are through the end of the third quarter of 2014. So the yield on our portfolio is slightly below that of the MLP Universe Index. It's basically in line with the infrastructure names, MLP infrastructure names, which have a slightly lower yield than the broader index. So 4.5% current income on our portfolio. Why is that? The next slide hopefully will shed some light on it. Distribution growth. The cash flow growth, and I mentioned it earlier, across the MLP Universe Index, so across all MLPs, was 7.1% year over year. The cash flow growth that investors received from a Yorkville portfolio grew by 27% over the same time period. So 4x the growth rate from distribution, or distribution growth rate, came out of our portfolio relative to the broader market. This is how we as investors in MLPs add value to you. Our investment thesis is that, and the investment objective of all strategies or funds that Yorkville offers to investors, have two investment objectives. Number one is stability of income, first and foremost. If we don't have stability of income from the partnership we're investing in, which means a low probability that it will cut its distribution, we're not interested in investing. That's a condition precedent. We have to have stability of income. And once a partnership or an investment meets that criteria, then we're looking for clearly identifiable catalysts for future distribution growth. And as you can see here, we're pretty good at selecting partnerships that are growing more rapidly than the overall asset class. The portfolio grew at 4 times greater. Historically, it's grown. The distribution growth has been in the mid-teen levels relative to the overall asset class. Why is distribution growth so important? It's really the investment thesis underpinning MLPs, and I touched on it briefly earlier. It has 4 benefits to investors. Number one, distribution growth provides a hedge against inflation, protection against rising interest rates. MLPs that are growing their distributions more rapidly are less likely to cut distributions, so greater income stability. And number 4, distribution growth drives price returns. So faster distribution growth, we would expect better total returns coming out of a portfolio that offers faster distribution growth. So clearly we're able to deliver on that objective, and that's one of the things you should continue to focus on as Yorkville, as investors. Are we delivering on our dual mandates, income stability and distribution growth? The next page here in the presentation looks at it. The stability score across our portfolio was 10. Again, score from 1 to 10. 10 means 100% of the names in our portfolio maintained or increased their distributions, and by how much, I spent a lot of time saying by 27% in the most recent quarter on a year-over-year basis. We publish these numbers on our website. We're extremely transparent into our scorecard. This is really our scorecard. It's our report card on how we're managing. It's a report card of the asset class, number one, and then it's a report card on each of our strategies. The core income returns for the third quarter, in this case, and whether fundamentals are there, we're not always going to win on every quarter. Well, definitely not every day, every week, every month, every quarter, every year. We slightly outperformed the MLP universe for the quarter. We're up 1.8% versus 1.7%, so roughly in line for third quarter returns, although the fundamentals were much stronger based on distribution growth. The attribution within our portfolio, it's a well-diversified portfolio. Although we run a concentrated portfolio of 15 names, you still find that we're in 7 out of the 10 sectors within the portfolio. Natural gas pipelines, energy services, both produce positive results for us on the quarter. Exploration and production companies and marine transportation, we're slightly negative on the quarter. We're happy to get into names, probably not on this call, but if you want to speak to us offline and call in, we're always available to have conversations with investors on a one-on-one basis and actually encourage that. So the longer term is what we like to, if we deliver the fundamentals, long-term stability of income, and I'm going to repeat myself again, 100% of the names maintained or increased distributions in the worst crisis of our lifetimes in our MLP core income strategy, and we deliver the growth that we have historically, the returns will take care of themselves. So we stay focused on fundamentals. We don't know what's going to happen with price, but if like a bond, if you're getting paid your interest, if you're getting paid your distributions from the MLPs and they're growing, your investment will be safe long term. Or at least from a performance standpoint. The quarter I touched on year to date, we're up, the MLP core income strategy is up 30% through the third quarter of 2014. MLPs, as I mentioned earlier, are up 21%, so we're delivering 50% alpha based on our stronger fundamentals, our faster distribution growth across our portfolio, so better fundamentals, again, what we have control over as analysts, as a research-driven investment firm. Our 3-year annualized numbers, as you can see, we've delivered, and I'm not promising these, this is what we have done in the past. We've delivered 41% on an annualized basis in our MLP core income over the past 3 years versus 24% for MLPs. So we've almost doubled the returns of the market, and the S&P 500 has delivered 23% returns in line with MLPs. So where can we add value as a firm? We add value on fundamentals, stability of income, growth of income, identifying the partnerships that have a low probability of cutting their distributions with clearly identifiable catalysts for future distribution growth. Long term, we believe that's the winning strategy, viewing MLPs as a total return investment based on fundamentals, your cash flow. So Yorkville's MLP core income strategy is the blue chip growth investment in U.S. energy infrastructure. I invite you, if we don't have a chance to answer your questions, look at our website, yorkvillecapital.com. We spend a lot of time producing information to help educate investors on the asset class. We are financial innovators. We're also investment educators at the same time. We have a dual mandate here. So I want to thank you for listening to my prepared comments. I'm now going to turn it over to Will Hershey to answer any Q&A, and then Len and Jim, who have been quiet, are going to come on the Q&A side and answer your questions. So please type your questions in. Will, I'll turn it over to you.
Yeah, just to reiterate, please feel free. We've already received several questions, but keep them coming in the top left corner of the online applet there, and I guess we'll just get started and get right into it. So I guess feel free, whoever would like to take a stab at the first one. The question is it possible that shale production has peaked in the U.S. with natural gas producers especially coming under pressure? And if so, what does that mean for MLPs going forward?
Well, yeah, Len, Jim, why don't you? Do you have comments? I have one, but I'll let you go first.
Start.
Okay, sure. So we were having a conversation last week, and one of the questions that came out from this conversation is, what are the recovery rates on unconventional shale plays currently? And so of the total resource right now with our current technologies, we're recovering approximately 10%, which is shocking. On traditional wells, the recovery rates are 80 to 90%. So is production peaking? I think given the technological advances we're seeing at improving recovery rates, which we've seen recovery rates already by adding more frac sand increased by 25% from where we were just a couple of years ago, so that go from 10 to 12.5%. We're nowhere near peaking because the growth in production is coming from unconventional shale plays. The recovery rates are 10%. If we could get recovery rates to 80 to 90%, I'm not claiming that we'll ever get there, but if we did, our resources would balloon, and we'd go from 50 years to hundreds of years of supply on hand. So no, I do not think we're anywhere near peak production within the United States. Jim, Len, do you want to add to that?
I think that's something else that we recently learned, and I think it's going to become significant in the future, and that is refracking, and which is something relatively new, and this may add a lot more to our reserves. As new techniques, and as Darren said, we've gotten so much more sophisticated with our drilling techniques. I mean, fracking has been around quite a while. It goes back to the 1990s, but it's only really been in the last 6 or 7 years, and the engineers and geologists are getting so much more sophisticated in finding new shale plays and exploiting them. So to answer the question and to just to elaborate on Darren's answer, I think we've got a long ways to go, and never is a long time, but I think it's going to be a long, long time in the future before we have to worry about running out of shale plays.
Thanks, Jim. And I guess a kind of a similar question that relates to kind of the sustainability aspect of it is growth at 7%. Do we think that that's doable over the next 10 years? And if so, how can MLPs continue to grow at such a rate?
Well, it's been history has shown that that's what they've delivered, and I think again, if you had asked this question perhaps in 2000, 2001, and people did ask me and ask Len back there, and we'd always come up with the same answer. The future looks pretty good. I think, however, in the last few years, I can say that I've been never more confident about the growth, and a lot of it has to do with what's happening with the shale plays that we're all familiar with, not only in gas but in shale oil as well. Again, going back a number of years, you would talk about drilling, in Texas and Oklahoma, Louisiana, Alaska, of course, but Mississippi. But now we're in a number of states, I mean, they always had some drilling in Pennsylvania, but now Pennsylvania is a pretty is a big success story. And here in the state of New York, I don't know what's going to happen here, but this could be a tremendous boon for upstate New York, where we are. So I think that the potential is there, and I have a great deal of faith in the technological innovation of these of the oil and gas industry.
Yeah, let me add one simple number that one of the most highly respected consultants in the energy sector has estimated that over the next 10 to 12 years, $1 trillion will be invested in the infrastructure, namely the pipelines, terminals, etc. And all of these projects, or almost all, I'm sure all of the projects, will only be viable if there's additional positive cash flow. And the people running the MLPs are highly experienced, and many of them, if not most of them, have significant interests. I'm talking about ownership of, inside ownership of the units themselves.
And just to Len's point here on the CapEx required of near $1 trillion or over $1 trillion over the next 10 to 12 years, the MLP entire market capitalization today of all master limited partnerships is roughly $600 billion. So this $1 trillion of new capital that will need to be spent to develop new energy toll roads, new pipelines, will ultimately more than double the size of the asset class. And MLPs, these companies, really, let's not call them MLPs, but these hard asset companies that own the pipelines have two ways of growing distributions. They're either going to build new assets, and that's where that $1 trillion comes from. That's the future growth from building, or they're going to buy from existing companies. So the two ways: you either build it or you buy it. And so given the $1 trillion of building or organic project opportunities, to Jim's earlier point, there's never been this transparency. We've never seen it as a firm or as an investment team where there's such a clearly identifiable need of future infrastructure projects to fuel future distribution growth. And to your point, and it was a good question on whether we can deliver 7% per annum, we've provided you the stability score and the growth score on the front page of our website at yorkvillecapital.com, so you can monitor the overall health of the asset class on your own. And we wouldn't argue if distribution growth starts to slow on a consistent basis, then the investment thesis that we've been discussing here changes. We don't see that happening anytime soon, but again, we're providing investors with the tools and the means by which to track the fundamentals of the asset class.
Thank you, guys. Another question here. Notice how, obviously, this being a quarterly review, most of the presentation focused on the third quarter. Obviously, we've seen a further decline in oil prices and a pullback in MLPs since the end of the quarter, with oil now trading in the mid-70s. After this sell-off, has your opinion of the MLP asset class changed? If so, why? And where do you see, kind of on a sector level, the most opportunities for investment going forward, or kind of in the near term?
Jim, Len?
Well, our opinion hasn't changed, and you'll pardon this gross cliche, but this is a phenomenal buying opportunity. We've already discussed in the earlier slides, the correlation between the oil price and gas price and MLPs, and that should answer that question pretty thoroughly. And we're still seeing today and last week Shell's IPO is up 45%, and today's MLP is up something on the order of 30%, which shows what the demand is for these things. And to add to that, that I would say that we are seeing tremendous interest and activity on the part of institutions, including, I might add, pensions, where the tax deferral of the MLPs has no significance whatsoever. So,
sure, and I think just to add to that, when you look at the different basins, really you're talking about break-evens that are well below where we are, even given the sell-off that we've already experienced in oil. So until we see $40 barrel oil, which I don't think any of us see is coming, we should be just fine. Moving on here, and I guess, Jim, why don't we give this one to you? Kind of plays into our portfolio, as a matter of fact. Currently, what are your favorite subsectors, and what are your thoughts on frac sand MLPs taking share from other proppant companies such as ceramics?
Well, to take the second question first, we have one sand play in our portfolio, which has done extremely well, and the research that we have done shows that sand seems to be an extremely good way to extract more oil and gas out of properties, and from a price standpoint, I think more and more people, at least talking to the managements of companies and others, that the exploration and production companies are price conscious, and ceramics are more expensive than sand. If you really get down to really difficult geographical formations, then ceramics is often preferred. But right now, the sand seems to be gaining more and more market share. As far as what sectors, we do specialize in the midstream. We know that money can be made in the E&P, the upstream companies, but as Darren has pointed out in the opening presentation, we like high stability scores, and we like to really count on the ability to project and be confident in our projections. So we do like. And another area that we particularly like, and we're skewed in our portfolios, are the general partners. And without getting into a long discussion about it, general partners are a way, some of them are MLPs, some of them are not MLPs, but they are a way to play and invest in MLPs with kind of getting a supercharged growth off of the MLP's distribution growth. And that's because of incentive distribution rights, IDRs, which again is a topic that we can get into at a later date.
And just a follow on, actually, from another participant, noticing that we have a sizable allocation in the MLP core income strategy to Emerge Energy Services, EMES. Just wondering how comfortable we are with the recent volatility from a price perspective in the name.
Well, anytime an investment is as volatile as EMES, it causes some angst. But fortunately, we got involved with Emerge at a significantly lower price, and we did listen. We've had conversations with the management of the EMES recently, and we listened intently to the conference call. I don't want to start making recommendations, on this call. That's not the purpose of this call. But we are maintaining. I think I can go so far as to say this: we are maintaining our position. And as far as the fundamentals of Emerge, we do believe that the fundamentals are intact, and very much so, as a matter of fact, but there's been a readjustment, obviously, as to what the discount rate should be applied to these future distributions.
Great. And you know, Jim, I'd like to add to that. I think when we look at the portfolio overall, whether it's infrastructure or an emerge, it needs to, on a company-by-company or investment-by-investment level, they need to meet our twin investment objectives. Number one, stability of distributions, very low probability of cutting distributions over our investment horizon. Investment horizons will change depending on what type of company we're looking at, longer for infrastructure, shorter for a company like emerge. So we need to feel comfortable that we have stability of distributions, and then once we have that, for the investment horizon, that we understand what the catalysts for future distribution growth are. And we see emerge fundamentally offering stability over the time frame and growth. They ended this year with around 3.8 million tons, or last year, correct? And this year they're adding 2.5 million tons, and then next year they're adding another 2.5 million. So they're more than doubling their capacity going into next year. So we're very comfortable with the company specifically.
Thank you. Now, going to kind of combine two questions here into one, but I think it's important to address. What does the capital structure breakdown for MLPs generally look like, and what is the level of concern regarding the possibility of rising interest rates pressuring unit prices going forward? Rates eventually have to come up, right?
Well, I think that Darren addressed I believe, early in the presentation about rising interest rates, and we've gone back and have done a study, several studies that show that MLPs actually in the last 6 times that interest rates have gone up, 5 out of those 6 times MLPs have performed extremely, have done quite well. So I'm not. Bear in mind that when you look at an MLP, it is not a bond substitute. We are looking at growth in cash flow, which we feel in a rising interest rate environment will eventually bail you out over time. As far as the capital structure, most MLPs, and this is a pretty broad generalization, are capitalized at about 50-50. There are, of course, exceptions, but the market has a very strong discipline on MLPs, and if an MLP gets leveraged, then it makes it that much more difficult for them to raise not only debt but equity as well. So this is why the management of MLPs are very cognizant of what's going on with interest rates, and they've been very, very smart, by the way. In the last several years, the really well-managed MLPs, and almost all of them, have been issuing really long-term debt at very, very low interest rates. So they're locking in long-term debt at very, very low rates, and God bless the people that are buying the debt, but they feel comfortable doing it. So
absolutely,
great, and we feel wonderful when these debt issues or these issuance of debt are made.
Thanks, Jim. Len, I'll give this one to you. Try not to scare anyone off the call here, though. In light of the recent election results, what impact do we see on regulation and the possibility now for Keystone XL going forward? And kind of what do the results mean for energy and energy infrastructure in general?
The answer is very simply extremely positive for both the Keystone Pipeline, for regulation, and for energy production in the United States to boom and eventually result in export, which is just beginning, by the way. Extremely positive.
Extremely positive. I would tend to agree there. Okay, let's see. We have another question coming in here. Does the MLP core income strategy use leverage? I can answer that. No. The answer is it's 100% long-only separate account strategy. consisting of a basket of MLPs. Another question that we actually received earlier, could you address the cost related to K1s and suggest a potential minimum account size?
Okay. Why don't I take that one? And so what the MLP core income strategy is based on separately managed accounts, which means the benefit to the investor is twofold. Number one, it's undisputed that the best exposure an investor can gain to the MLP asset class is direct exposure, which means owning the underlying partnerships directly in a custody account held in their name. And that's what we offer. And there's a reason we offer SMAs and built our business initially around SMAs was because it offers the best exposure to investors. So it offers the best exposure for two reasons. Number one, it's the best total return that an investor can get from the asset class. And two, it is the most tax efficient exposure. So a general rule of MLPs, 80% of the income that the partnerships produce is tax deferred, not tax-free, tax deferred, that ultimately, as long as you own the partnership, the income, with the return of capital portion of the income is not taxed until the partnership is sold, and then it is recaptured and taxed as ordinary income. So if you own it for 5 years, it's a tax-free loan from the government for 5 years, 10 years, tax-free. And there's one other benefit, which is nuanced. If you own it for 10 years and it passes into your estate, with a step-up of cost basis, the deferred tax liability also disappears. So then it actually does become tax-free income at that point, the return on capital portion. There is a cost. So those are the benefits: better total return, best total return potential, and best tax treatment of the income. The downside is these are master limited partnerships. So the partnerships require K1s, and K1s are more expensive for an accountant to prepare taxes on at the end of the year, and so that just goes with the territory. Rule of thumb, and if you look at $50 to $100 per K1 for preparation, if you have a portfolio that has a 20 K1s that it'll be producing at the end of the year, that's going to be $1,000 to $2,000 in additional tax work. Well, clearly on a $1 million account that's producing, not even returns that we have historically, but 10%, it's going to produce $100,000 in profit per year, or total return per year. So $1,000 to $2,000 is not a significant amount, and that's just on the profit of the portfolio. Smaller accounts, it's a cost-benefit analysis of the additional cost in taxes relative to the account size, and we can handle small SMAs. We manage them with fewer names in our core income strategy to cut down on the tax costs. So we have a solution there, and so we're flexible if you want to discuss that more with us on other alternatives for smaller accounts. There is something there, but I think when you're looking at it and looking at what the cost would be, that's a good rule of thumb, and it's also something to go talk to your tax preparers about, that you come armed with, this is what I think it should cost.
Great, thanks, Darren. I think we have time for about one more question here. Jim, I'll give this one to you. What are your thoughts regarding, and it's rather timely given that the deal is set to close just around Thanksgiving here, what are your thoughts regarding the Kinder Morgan transaction moving into bundling all the MLPs up into a C Corp, and kind of what do we think that means, or does it have any impact on the MLP structure and its viability going forward?
I think this was a unique situation, and I think we may have talked about this on the past conference call, the previous conference call. But Kinder Morgan, the partnership, KMP, was faced with a rising cost of capital because of something that I discussed briefly before, and that's about the general partner, which is KMI in this instance, have IDRs, is incentive distribution rights, and this really pushes up your cost of capital. So Rich Kinder, I think, was dismayed over the last couple of years about the price action of KMP and KMR, and it came as a big surprise, a very positive surprise to Wall Street and to investors when it was announced that KMI was going to buy El Paso and KMP and KMR. There are, unfortunately, for KMP unit holders, some tax implications, but I think this has been much more offset by the premium that KMI is paying for KMP and KMR. As far as KMI, and again, I don't want to get into making recommendations on this conference call, but let me just say that many of us have been investors in Kinder for a long time, and we have a great deal of faith in Rich Kinder, and I think this new structure, it's not really a new structure, but it's combining El Paso and KMP and KMR in KMI, and I'm just putting out here what estimates are, and that is that the company itself, it's a corporation, KMI, has estimated that they'll be able to grow their dividends, not distributions, 10% a year. We think it's a great transaction, and we like what Rich Kinder did.
Thanks, Jim. I think we agree. It was definitely a unique situation. MLPs are here to stay. So we're just coming up on an hour, our allotted time here. So for any of the outstanding questions that we have in the queue, we will be sure to follow up and get back to you. In addition, we're always available to take questions. You can always reach us at our toll-free number, 877-317-8128. And that should just about wrap it up for this quarter's call. Just want to thank everyone again for taking the time, and we look forward to having a successful quarter here, and just want to thank everyone again. So thank you.